Hello scholars, today we are going to discuss basics of shares and equity. When we talk about investing, simple meaning of investing is buying assets. Now the assets can be classified different ways, and we discussed previously as well that there are generic products and branded products. Generic products are very few and it is easy. So when you start learning investing, focus on generic products. The branded products are too many and you will get confused. So what are the generic product in which we say that physical asset which are real, that is gold coin, jewelry, or real estate, you can see them, you can touch them. This is a physical asset which is real, you can see them. Then there is another asset which is physical asset securities. For example, gold bees, REIT, that is real estate investment trust, and these are based on the backed by the real asset. That's why I categorize them into real asset securities. Securities means that has made into the securities which can be bought and sold, but the price is or all is depend upon backed by the underlying physical asset. Then there is another class, financial asset, that is debt. These are not backed as such by anything. It is basically obligation of returning the money and interest. Then another asset is financial asset, which is equity. This is ownership. When you buy shares, you are buying actually ownership. Okay, that is financial asset. So these four are important for you to understand. This we will learn. We will never learn this. This is waste of my time. ETF and mutual funds have been discussed in the step one videos. So what you do whenever you get time, start watching step one videos. There are I think 19 step one videos. You watch them. It will take time to watch. You can revise later on. Most of the content are the of ETF and mutual funds are detailed discussed detail here. Here we will focus on the generic products, and today's video is about equity. Debt product we discussed in the previous video number 3 of IMP. Let's talk about company and equity. When we talk about equity, equity means ownership. Now, the if you search meaning of equity on Google, there are multiple meanings. But here in the stock market, equity is related to the shares. There is another word, stock. Sometimes we say stock market, we say share market. What is the difference? Practically, there is no difference, but theoretically, difference is share is a specific company. Let's say Reliance company, HDFC Bank company. It is a specific to particular company share. And stock is a general. In general, we say I bought stocks. These are theoretical differences, but practically both are same. Then we use another word, scrip. Okay. Now the scrip is any financial instrument. Whatever we are discussing, these are the any financial instrument, that is a scrip. So be aware of these words. We keep on using share, stock, scrip intermittently, but for practical purpose they are same. Theoretically there are differences which is not relevant for that. When we talk about equity, it is share market. When we buy share in the company, so when even if you buy one share of Reliance, you are the owner of that fractional ownership. That means there are crores of shares, maybe 800 or 900 crores shares issued by the Reliance. And if you buy, you are still owner of that small part. So this is ownership. Now, before understanding equity, you have to understand few basic principles so that you will not get confused. Number one, company is an eternal entity. Why this assumption is important? Because accounting people create a statement based on this assumption that company will be forever. Accordingly, depreciation, expenses, accounting is done. So this you have to understand that company is forever entity. Second is company is separate from promoter. Mukesh Ambani is a separate, Reliance is a separate. So it is a separate from promoter. Company is separate from the shareholder as well. For company, shareholder is a liability. And that is what they are shown in the liability section of the balance sheet. So these three assumptions are critical in understanding of shares and companies. So let's go to another step of this is going to be interesting. We all know that company or any business entity can sell the goods and services. Okay, let's say hospital or any goods, services, transport, business, education, whatever. Company can sell goods and services, and company can get money from selling the goods and services and profit. Company can sell the shares and get the money. In addition to that, company can sell the bonds and get the money. So there are, we, if you remember, I mentioned you, there is walk and sock formula, that is working income, asset income, loan, and kindness. Company does not get the gift, maybe sometime gift from the government, but usually company earns by selling the goods and shares. Company can take the loan. Okay, company can earn money by selling the assets as well. Okay, so here I can add one more point here. Company can sell the its own asset. Okay, there are some holding companies, or even if you look at the Zomato, they their main earning is from the selling the assets. That means they buy and sell the mutual funds, or they are doing trading. So these are the four things company can get money. Okay, selling the goods and services, selling the shares, selling the bonds, and selling the assets. Okay, so now I give you example here. MRF sell the goods and services. They don't sell the shares at the beginning. Whatever they sold, thereafter they have not sold fresh shares. But there are companies, they keep selling shares every year. For example, Reliance, Zomato. There are many companies, they keep on selling the shares as well, so they get the money. So even if they are not getting profit, they can get money from the cash flow from the selling the shares. Some company prefer to sell the bonds and loans. For example, Adani Group, they prefer to sell the loans and bonds rather than the shares. Reliance, here I'll say, type Reliance so that you can better understand that. So Reliance keeps selling shares every year in addition to goods and services as well. So that's why share capital keep on increasing. Share capital is the number of shares multiplied by face value. Okay. Now let's take one example and understand how this share issue or selling shares business happen. Okay, so let's say this is Dr. Kiran. He started Delta Hospital and registered as a private limited company. He issued 2 crore shares to himself. Now company is a separate Delta Hospital and Dr. Kiran is a shareholder. Company issued 2 crores, and at the beginning share price, we say this is at face value, that means starting value. Face value, what is a face value? Write down, face value is a nominal value, full stop. It is used to calculate the dividend, full stop. And it is used to calculate the share capital. What is the share capital? Share capital is the multiplication of face value and number of shares. Okay, share capital is, write down, share capital is equal to face value multiplied by number of shares. Usually face value is 10 rupees as a tradition. Why 10? Why not 20? This is tradition since 300 years. So it is 10 rupees. So at the beginning, we say that he issued 2 crore shares at the 10 rupees face value. So at the beginning, market capitalization or market value of his company is 20 crore. 10 is a starting per share price, and total number of shares is 2 crores. So 20 crore. So he deposited 20 crore in his bank, his own asset. I am not taking loan here because we are explaining the basic concept here. Thereafter, he started doing business of hospital, treating the patients. And after 1 year, let's say he earned 4 crore profit. Now, the 20 crore is the total asset which he invested. 4 crore profit is realistic. It is not something hypothetical. It happens. Okay. Now we'll calculate the earning per share. How do you calculate earning per share? That is EPS. Earning per share it means whatever the profit after tax divided by the total number of shares. Okay, so write down here EPS, that is earning per share, is equal to profit after tax divided by number of shares. Number of outstanding shares, that means company have that shares. This is EPS. Here, profit after tax was 4 crore and number of shares were 2 crore here. So EPS is 2 rupees per share. 2 rupees per share. Okay. So understand these values. Okay. This EPS is in rupees, share price in rupees. This is a number. Number of shares in crores. How many crores? After 1 year, he wanted to expand the hospital. So he approached to the one angel investor, let's say his own friend. We will talk him, we'll give him name as A, angel investor. So what he says that, can you invest in my company? Angel investor A says, okay, I'll invest. So this Delta company issues 1 crore shares to A. Now, why Delta Hospital will give him share? He has to give the money. Okay. So how much money? You have to decide the share price. So share price, we say at what price he will sell. So there must be some valuation parameter on the basis of share price we decided. For time being, we will say that it is based on the earning per share, that is 20 time of EPS. Okay, 20 time of EPS. This is as of now for your basic understanding. 20 times of EPS. Okay. It is not a rule. Be aware, it is not rule. Sometimes share price can be issued at 40 times of EPS, sometimes 25. It depends upon market condition. But just for your understanding, I'm taking 20. So EPS is 20. How much will be the share price? It will be 40 rupees. Why? 20 multiply by 20. Okay. So here we are using which model? We are using PE multiple, that is price multiple of EPS. So 40 rupees is a share price. A bought 1 crore shares. So he'll have to pay 40 crores here. Okay. So asset, I am just keeping for simplicity. Initial asset were 20 crores, which is shared by the, which is pulled by the Dr. Kiran. Now the angel investor person A is giving another round of investing where he has to buy shares at 40 rupees. Now the share price initially it was 10 rupees bound, but now it is 40 rupees because the valuation is increased. He bought 1 crore shares. So asset will keep 40 here. In addition to that, A pulled some money. What will be the market value as of now? The market value or market capitalization, write down now. Market value, also called as market capitalization, is equal to share price. Which is share price? That is market share price now. Multiply by number of shares at that moment. How many shares are existing at this moment? 3. Why 3? Initially, 2 were issued to the Kiran. Now additional 1 is issued to the A. So now total number of shares are 3. Share price is 40. So if you multiply this total number of shares multiply by share price, you get the market value. It is also called as market capitalization. Meaning is 1 and same. Market capitalization is market value, which is calculated from the number of shares multiplied by share price. And because new capital came into picture, assets are increased. So hospital, after 1 or 2 years, hospital earn profit of 12 crore. So how much will be the earning per share? Profit after tax divided by number of shares. Number of shares were 3 crores. Numbers are in crores. So 12 divided by 3 is equal to earning per share will be the 4 rupees. EPS is in rupees. 4 rupees is the EPS. Now this Kiran and A decided that we want to make this company as a public and we want to issue shares to the public. Okay, then they apply for the IPO, that is initial public offering. Now the IPO is a big process in which a company apply to the SEBI, National Stock Exchange. There is a scrutiny. They hire the investment banker, they hire the marketing team, and there is a lot of process involved in the IPO. So the IPO is also called as primary market. So what is a primary market? Primary market is the market in which initial public offering or initial public issue of share is completed. and thereafter listing happen on the stock market. So in fact, IPO is just a pre-listing phase where companies sell share directly to the investor. In a secondary market or stock exchange, investor buy and sell shares from each other. Write down. In IPO or primary market, companies sell shares to investor directly in a primary market in IPO. In secondary market, investors sell shares among each other. Full stop. So in the IPO, what company has decided that they decided that A want to exit. So his 1 crore shares they want to exit. Even Kiran wants to sell uh, some of his shares. So we'll say he want to also some exit. Let's say one crore shares. In addition to that, Delta company also wants some funds to expansion. So this is Delta company is selling. Now 3 crores, 3 crore shares are coming, out of which two are called as offer for sale. So write down the terminology is offer for sale, in which the existing shareholder sell their stake. Offer for. Then fresh issue is company is selling. So money will go to the company, not shareholder. So in which here public will buy 3 crore share, out of which 1 crore belongs to A, 1 crore belong to Kiran A, and 1 crore company is issuing fresh shares. So company will get only money of fresh shares. They will not get any money of offer for sale. So this is very important parameter in IPO analysis, whether this is offer for sale, that means existing shareholder are going away or exiting their position, or company is issuing fresh shares. Usually company issuing fresh share is good for investing. And if entire is offer for sale, then you have to take pinch of with the pinch of salt, because why these people are selling? It may be their company is not a good prospect, etc. But that is a discussion about. Here we are just understanding the concept of how equity is issued. Okay, so 3 crores sold in the public. Now, how many will be the total shares after the issue? Now, here one crore shares are remaining with the Kiran and 3 crore with the public. A has exited. Okay, now after the public IPO, this will be the shareholding pattern where A has vanished by selling the shares to the public, and Kiran has kept one crore shares. So total number of shares are 4 crore after issue. Now they have decided that they will sell 3 crore shares, but what price? So price is, we say, I am taking here multiple of EPS. So 20 times of EPS become 80 rupees. Okay. Now here company issued 1 crore fresh share. So it will get only 80 crores. Rest of the amount has gone to the Kiran and A. Okay. So company asset here are initially Dr. Kiran has added 20 lakhs. Thereafter, A also had 40 lakhs, and then public added 80 lakhs. So this is approximate their asset. This is not exactly how asset look like, but this is for your conceptual understanding, because asset will increase by adding the PAT as well. That means asset will not be the same. It might go up because this profit will also added here. But for simplicity, I'm just keeping here that asset will increases after fresh issue. So here initially 20, then a fresh issue issued here as well. These are the fresh shares which are, and these are the fresh shares. So company gets money from the issuing the shares. Okay. So this is how company issue fresh shares. Now you may ask a very critical question. How can companies sell the shares from air? This is the magic, and this is the beauty of modern finance. Company can issue shares unlimited. What they just need to pass the resolution by the board of director and get approved by the ROC or SEBI, and they can issue unlimited number of shares from the air. Now you may be wondering then why company can't just get money by issuing unlimited number of shares. The question remains, there should be buyer. Why will people keep on buy? Why people will buy shares? And there is some basis as well. So such thing happen, it becomes Ponzi. If they just company issuing share without doing actual business, that is a Ponzi scheme. It may happen in a small cap companies or real Ponzi schemes, but in reality, there is a constraint. There is a limit how many shares they can buy. So what is the first limit? Is the buyers. Buyers should be ready, and another is existing shareholder. Existing shareholder will also have to approve it, because when fresh shares are issued, the stake is diluted. How? For example, in this case, Kiran has enter 100% shares, okay, 2 by 2. But when after selling fresh share to the A, what has happened? His share stake has reduced. Let's say 2 shares and total divided by 3. 3 is total number of shares. So his stake is reduced by 66%. So if company keep on selling the fresh shares to the other, let's say investor A, investor B, that is how these startup companies are doing. Many of them are just a Ponzi schemes. What they are doing is not a real business, but just raising the funds from the investor. It is called as funding by A round, B round, C round. Whenever fresh investor come, the stake or percentage of holding of existing investor goes down. Okay, so existing shareholder will also not allow company to dilute this. Okay, and then market mechanism, there are ROC, that is a government, there are ROCs, registered of company, then SEBI, then stock market. These people also not allow to run the Ponzi scams. But yes, theoretically, can companies sell the issue unlimited? Answer yes. Practically, it does not happen unless it is a Ponzi scheme. Okay. So what I suggest, you read IPO, about IPO, how IPO is done. We are not discussing everything IPO in the IMP. Reason, we don't invest into IPO. We trade on the stock exchange. Okay. So the logistic or theory you can read from the chat GPT, Google, books, everywhere. It is a standard information. So IPO procedure, you can read it. I explained the concept, what is IPO and why it is done. Our main focus is on secondary market, so we cannot spare too much time on IPO where we don't buy IPO. Okay, but for theoretically, you should know the IPO process, because eventually this you need entire information. Okay, thank you very much.